Welcome to Coffee and Crypto with Lee and Jimmie. I am Lee Reiners, joined as always by the one, the only, Jimmie Lands. Jimmie, how you doing today?
Lee, I'm a little cold and wet this morning. I took the dog out a little while ago, and it's feeling
Oof.
like kind of like the area you were raised in. It's here we
I
are,
wouldn't go
early
that far.
December, and it's
Minnesota's
feeling
covered in snow.
snow-like.
Yeah, well, there's no snow on the ground, so be
No
thankful.
snow, no snow, but it's cold as all outside. It's cold and it's very wet here.
It's winter, man.
No golf, that's for sure.
Definitely not.
So
Definitely not today.
we're gonna have to stay inside and I don't know, drink. I don't know. That's
It's
what they do up north,
Friday.
right?
It's Friday, absolutely. As long as daycare doesn't close, that's the one thing I care about. Is please God, daycare stay open, and they're open. So good news there.
How the
Hope you
boys
had.
doing? The boys excited about Christmas?
Oh yeah, they're pumped. Well, the
Yeah.
2-year-old, my youngest is going to turn 2 on Monday.
Yeah. Well, I knew it was
So
coming up.
yep. So birthday coming up here on Monday, and the 4-year-old loves Christmas. So he's pumped. He can't wait. So I love the holiday season. I've always been a big Christmas guy. We got the
Me
decorations
too.
up,
I'm
and
a huge fan of Christmas.
yeah, it's
I
really
love the season.
I'm
Love
disappointed in
having
my
people over.
neighbors. My neighbors just the decorations just lacking. You
Really?
know, yeah. So I don't think they listen to this podcast, but if they do, get on it, folks. Come on.
Come on, folks. It's
You know,
December. You got to get
it's
stuff out there. Got to get stuff
festive.
going.
Well, speaking of getting stuff going, Jimmie, we are getting stuff going. You are getting stuff going. So first reminder, Digital Assets at Duke. We are adding new speakers every almost day at this point, right?
Almost every day now.
But just
We're
fantastic
and for those,
speakers.
I want to say something for those people who did not, who are not reaching out to. It's not because we only have so much time, really.
Oh
I
yeah,
mean, we try to be very judicious about the speakers and the topics and things like that every year. And so it just kind of know that we love having people there. And the thing about Digital Assets at Duke that's really different. It's not like there's a stage and you hear from 4 people at a time, 3 people. It's the audience, right? It is. If you haven't been to Digital Assets at Duke, this is the most participatory conference you will ever go to. The audience, it's a giant discussion. It's
Yeah.
just led by some people on a stage.
Yeah. If you don't like taking questions and questions that you may not be able to predict in advance, then you should not be a speaker at Digital Assets at Duke. I'll put it that way.
Yeah.
Because this is all about learning. I mean, no one's trying to, no one's playing gotcha, right? I mean, these are
Nope.
all reasonable questions, right? I mean, it's a learn. We're here to learn, right?
We're here to learn. We're here to discuss. It's not that things don't come up. Topics are. We certainly have challenging topics and topics open for debate, but we do encourage debate. We do encourage robust debate. And I think that makes this a little bit different. But we do have questions from the audience. They're real questions. People, want to know these things, and this is one of the reasons you have regulators here and industry folks here, and
builders. We have the builders.
Lots of builders here. So
and we have folks. I mean, let's face it, Jimmie, right? The whole premise of Digital Assets at Duke is to be a different type of crypto conference. Okay,
we are very different,
and we know that for the other crypto conferences, and there's one every week. So we're kind of piling on, I guess, but we're offering a differentiated product. It's a lot of the same speakers repeating a lot of the same talking points. But in the meantime, right, there are companies out there that are building stuff, working on products.
Yeah,
we get those people. So if you want to know what JP Morgan is doing, for instance, around JPM dollar and tokenized deposits, we got the guy doing it, right?
I was going to say we have the guy. If you want to hear about,
we got Zach Chestnut, right?
If you want to hear about how Swift is integrating stuff, we kind of have the guy who's doing it.
We got the guy.
Tom will be here.
Exactly.
If you want to hear about government things in government, the people that kind of ushered this in government, Bo Hines is going to be here, and the former comptroller of the currency who ushered through the Stablecoin Act. I mean, Rodney Hood will be here.
We have the head of innovation from the UK's Financial Conduct Authority. Okay.
I mean,
Colin Payne. So if you want to learn what the UK is doing, I mean, the list goes on and on. If you want to learn, okay, crypto treasury companies, digital asset treasury companies, we've been critical of those, but it's a big thing. If you want to learn about the architect behind strategy, pun intended, we got the guy. We got Ed Julian. Okay. So these are folks that you may not see at your normal kind of crypto conferences, right? Because they're busy, right? They
They're
don't have
busy. They're
time.
building things. They're
but we're
building things.
but they're willing to come down to Duke, which is just, we're very obviously appreciative of that. So folks, go take a look at the website. Again, we're adding speakers, by the week. Digitalassets@duke.org. Make sure you register if you haven't registered yet. Obviously, you can always email Jimmie or I if you have questions or
Yeah.
feedback on anything. And with that, Jimmie, you are also working on something that's pretty cool. A
We
new survey. So this is kind of, the model, I guess, is the University of Michigan Consumer Sentiment Survey. But you
Yep.
are creating a new survey to gauge opinions
Digital
on digital
asset
assets,
sentiment.
right?
Yep.
Yeah. So
Digital
tell me more
asset
about that.
sentiment. We sent out the first. We're going to be sending this out in waves because we didn't want to assault a million people with this. But we did put a little notice out on LinkedIn, and we'll be sending out some more. We do have a sentiment survey, digital asset sentiment survey. It's, it'll probably take you 10 minutes to do. It's not too onerous, but we would love to hear from as many people as possible. I mean, this is, these types of, and this is something, this isn't a one and done. We're going to do this twice a year, every year going forward. Professor Marvin Chang and I have, a lot of you actually I contacted for the questions. So the questions came from a lot of the people that are probably listening here and
Nice.
that participate in other things that we do. Because we wanted to make sure that we had questions that were on top of mind.
Yeah.
That people were worried about, people were thinking about. And so what we're really trying to gauge is what is the sentiment in both for individuals and for businesses around crypto or digital assets, not cryptocurrencies, digital assets in general,
Mm-hmm.
and kind of where your companies are, where you are. And we would like to have this be a barometer of the market kind of going forward. My thought is that we will publish these out just like other sentiment surveys are published out. The first report out will actually be at Digital Assets at Duke in February, and then we will release it. But we expect that this will be one of those surveys that people start to depend on and to gauge, what's the strength of the industry, where's the industry going, how are things being adopted. So I'm really excited about this. This has been probably a year in the planning to try to get the questions that we need and things like that. And so some friends at Alpha Rock helped us out with the distribution of this, which I want to give them a little plug because they did this all gratis. They're builders, and they were very interested in kind of the questions that we were asking. And
Okay.
so those guys have been really fun to work with on this. So anyway, we're in the midst of starting the survey. So if you haven't answered it yet, please do. And you can find the link on LinkedIn. Let's put it in the show notes too.
Let's do it. I'll do it.
Okay.
Absolutely.
Okay. Perfect.
Yeah. I mean, this is awesome. Thank you, Alpha Rock. It'd be great, Jimmie, if, the Duke Digital Asset Sentiment Survey could sort of take it, right? It'd be the gold standard, sort of, nonpartisan survey. Because, the industry, as all industries do, they commission polls and surveys. And, if you read the methodology, they're generally skewed to get the results that that they want.
Shocking.
Exactly. But as an academic institution, right? I mean, you have no skin in the game.
I don't.
So if we can, provide kind of an unbiased resource for folks to just sort of assess where the market's at, how people feel about it, that would be fantastic. So please take a look at the survey. Again, we'll put a link in the show notes. And I got to get on it too, man. I'm going to do the survey today.
Yeah, you got it. You got to answer it. I think that one of the things that digital assets has, and it's new, it's a maturing industry and things like that, is you don't have some of the things that we have in other asset classes. We don't have the amount of metrics coming out, in particular objective metrics coming out.
Yeah.
And so this is a way I think that should give people a different perspective. And I fully expect that this is going to be used by both individuals, companies, and by the press to engage the industry.
So, Jimmie, does the survey include any questions on leverage?
We don't have any on leverage.
What do you think about leverage?
What do I think about leverage? Well, leverage is a mainstay in finance, right? Let's face it. Leverage is, the very, very core. It's funny. I actually asked this question to my students, around leverage. I mean, banking is built. Fractional banking is the definition of leverage. That's what leverage, that's where it starts. And I know, digital assets is certainly no stranger to leverage. It's been around for a
Yeah.
long time. And there was that nice piece that you sent me from the FT.
Yeah, your favorite paper, right?
It is.
And this was a great article from Elizabeth Mankey, who's an investment banker, and she teaches accounting at Fordham, and Wendy Carver, who works for Bankwise. I think they do digital asset related work. And it was all about leverage in the crypto economy.
Mm-hmm.
And one of the things that I've heard over the years, Jimmie, when the discussion sort of turns to systemic risk in crypto markets, is folks within crypto will say, well, there's not leverage, right? And leverage, every sort of financial bubble, every type of banking crisis, financial crisis, right? What is the core, right? The core driver?
Right.
Leverage, right?
Leverage.
Generally excessive leverage.
Pretty much always leverage.
Yeah. And, and look, obviously I think
and it makes sense, right? It makes sense. That would be the case.
Well, and I do, in the fall, I teach an undergrad intro to financial regulation course, right? And a lot of financial regulation is around addressing the risk associated with leverage.
Yeah.
And I just do a simple example of buying a house, right?
Yeah.
And what happens to your returns if you have 20% down versus 5% down,
yeah.
Right? And the whole point, the takeaway is that leverage amplifies returns.
Sure.
Right. And this is why some of the richest people in the world who could pay cash for houses, whatever they want, borrow, right?
Borrow,
because,
absolutely. It's amazing that that's the case, and people don't realize it, but that is definitely the case. Leverage is, there's power in leverage, and so one of the reasons that
but there's danger.
There's also danger, but one of the reasons that there's certain financial products have gotten really, really, really popular is because they have just implied leverage. Options have gone crazy in the past 5 years. The amount of options traded and the amount of options offered and things like that, just listed options on equities and things like that. And why? Leverage. It's very simple. It's plain leverage.
So despite what the crypto industry has claimed, and not everyone, but there is leverage in crypto. We don't know exactly how much. Again, the industry claims, well, everything, it's on chain, everything's transparent. It's like, no, that's not how the chain works, right? We can see, balances held in wallet addresses, right?
Right.
But that doesn't tell us, if it's been rehypothecated or, anything like that.
Sure.
Right? So we're kind of flying blind a little bit. And sometimes we find out the hard way, as we did in October 8th with the crash, right? And we talked about that a few months ago. And so they said, this article says that, open interest in crypto derivatives had reached an all-time high of roughly $115 billion. And then within a day, 20 billion in trades were liquidated. Okay. So we covered that previously. So this article really, I wanted to talk about it just because I think it does a good job of sort of explaining how leverage can be formed in crypto. And it's just something that I don't think a lot of policymakers are talking about, and certainly Capitol Hill is not thinking about as they draft this market structure legislation. So let me just read a little snippet here, Jimmie, from the article,
sure.
and then get your thoughts, because they say, okay, what does leverage look like in practice? So they say, suppose a trader drops one Bitcoin into a centralized exchange and ticks the box for cross margining, meaning that single deposit backs everything they do. So they put on a long perp at roughly 4 times, okay? Throw on a small ETH Bitcoin short as a hedge, and lend part of their Bitcoin back to the venue for a bit of yield. So depending on how you calculate it, the effective leverage now sits somewhere around 5.5 times, okay? And then they go on to say, meanwhile, the exchange doesn't just, hold that Bitcoin, right, idle. It rehypothecates it into liquidity pools or hands it off to market makers, right? Then you have a macro headline like we had with Donald Trump, saying we're going to tariff China, right? And then, Bitcoin slides 13%, ETH drops 17%. The trader's margin, which is the Bitcoin deposit, shrinks across every leg of her book. The perp goes red. The ETH Bitcoin short helps, but not enough, and they blow through their minimum margin. The risk engine kicks in, liquidates the account. The Bitcoin that they lent to the exchange was rehypothecated, is no longer fully there. And what remains of it is in other exposures that are also being liquidated. I thought that was a great explanation, Jimmie. What are your thoughts on this?
Okay, so I mean, the thing is this is common practice. I mean that the people are there's
Yeah,
this perception that this is like an anomaly. This doesn't happen in other markets, folks. This happens in every market.
yeah,
I mean, you can't. Whenever you give leverage, you're if you're the provider of leverage, you have to protect yourself. You have to do diligent risk management. And so one of the things that you have is the ability to sell out whatever collateral there is, to cover in case there's a loss. In listed markets, we call this margin calls. Everybody's familiar with these. The thing that most people don't understand, in very highly leveraged things like futures, you get a margin call every day. You have to true things up every day. Every day, if
yeah,
things are marked to the market. And if things start going crazy, they'll do it quicker. They'll do it intraday.
yeah,
Remember a few years ago when oil futures went negative?
yeah.
Market people were sold out right and left. Even people that weren't underwater, the people that had no
Hmm.
problems at all, exchanges sold out everybody. Some people had big profits. They didn't get to take
Yeah,
their profits. They were sold out. So this is, while I appreciate the article, I thought it was well done. I wish they would have put a basis of comparison in that
context.
this
Yeah,
happens. This happens in every market, folks.
yeah,
And if it
fair.
wasn't happening, I would be much more worried.
Yeah, fair enough. Yeah, and they're not claiming that this is anomalous or this doesn't
No,
happen. The central point is as I read it, is that um, basically the crypto market infrastructure is sort of not up to task with managing these leverage exposures, right? That's kind of where they're critical. And so they have this point, Jimmie, where they say, while the on-chain ledger lets us see wallet balances and posted collateral, that visibility drops once assets are pledged, lent out, wrapped, or bridged to another chain, basically anytime they leave the clean on-chain path. So
Mhm.
transparency mostly ends at the first hop. It tells you very little about anyone's actual leverage. And even if you can look at order books or pool depth, you still don't know how many of those assets have been reused, how intertwined the liquidity providers are, or how much of the liquidity is coming from transient market makers. Proof of reserves only shows the asset side of the picture, not the obligation sitting against it,
Yep.
right? So I
Yep.
think this is all pointing towards there's a lot of room for maturity in crypto markets.
Yeah.
Um, despite the original premise of crypto, this is going to require intermediaries, infrastructure, right? I mean, some of the firms that are coming to digital assets at Duke and working on in providing these solutions.
Yeah, there are some I would say very kind of a little bit boring, more vanilla
Hmm.
firms, both directly in the crypto space and in the traditional banking space that will be at digital assets, and they'll be talking about these things.
Yep.
I think that there are we're at a point now where we're starting to see a lot more crossover of the way people are managing risk and things like that. And hey, folks, managing risk is a sign of maturity. I mean, your 2-year-old doesn't do it well.
No.
You and I probably do it a little bit better, but only me a little bit. But you have to think about this as in terms of a mature market is going to be a little bit maybe more not risk averse, but
Yeah.
certainly risk conscious.
Yep.
And so these kinds of things have to occur. So yeah,
Yep.
I'm a fan of the of being very proactive in this space. I think if you're going to give leverage, there has to be something on the other side of it.
Yep. Uh, let's move on, Jimmy. I mean, look, I just to put a bow on this. I think where a lot of us are flying, I think most people are flying blind when it comes to leverage in the crypto economy, right? And so anytime you see something like that October 8th incident, people are always surprised. And it's going to happen again, folks, because there's always some type of exogenous shock that's going to, kick off these liquidation engines, right? And then
Yep.
we're all going to be doing these postmortems after the fact. And so I just don't know, like, at what point, this ends or how regulation addresses it, but it's endemic. All right, moving on. Tether. Okay, so we're gonna have a digital asset at Duke, Jimmy. Bo Hines. Okay, he is the CEO of Tether's new U.S. entity,
Yep.
and he was previously the President Trump's chief crypto advisor. Okay, so he
Hmm.
worked directly with David Sachs, and so it'll be interesting. I think one of the things we'll probably talk about with Bo in February is the recent announcement by S&P Global Ratings that they are going to downgrade, okay, US dollar Tether, so Tether's main stable coin,
Yep.
okay,
Well,
to
they're downgrading
weak
the assets.
They're downgrading the assets. That's right. They're downgrading
Yeah.
the assets to weak from constrained. Okay.
Hmm.
Now we actually had, and I forget her name, and I apologize if she's listening. A woman last year at Digital Assets at Duke who worked for last year, 2 years ago. I think it was last year. Who worked for S&P Global Ratings
Yeah. Oh,
because
we've had a couple of people from
they
S&P. Yeah. Yeah.
they created this new stablecoin rating framework,
Yep.
right? Which is different than how they rate, corporate bonds.
Yeah.
Just to put that out there, folks. But what they said in their assessment was that they were concerned about an increase in high risk assets backing US dollar tether, including corporate bonds, precious metals, bitcoins, and secured loans. All of those accounted for 24% of total reserves at the end of September, up from 17% a year ago. And they say that a decline in the price of Bitcoin or the value of other higher risk assets could therefore reduce collateral coverage and result in US dollar tether becoming under collateralized. Now, Jimmie, since there's been, for the last 10 years, we've been having these conversations about
Yeah.
tether, right? It's given rise to, a whole category of people called tether truthers, right?
Yep.
So there's been shadows hanging over tether for a long time. They still have not provided a full audit, right? They do attestations. I read
Yeah.
another kind of blog post from interesting perspective who says, look, at this point in time, if a company hasn't provided an audit, there's generally a reason for it, and that reason is not good. So I don't know what to say other than this is just kind of like a recurring story here, but
it is.
Look, it's lurking risk. Back to the leverage point, Tether's. This is a systemic risk for the crypto economy. You're talking, maybe even the broader economy. You're talking $184 billion.
$1 billion. Yeah. Yeah.
Right.
It's huge. It's huge. And I would think that the folks that hold Tether would be a little more savvy about these assets. I think the one nice thing that we saw in the Genius Act was it was very prescriptive about the assets. And the assets that are allowed are pretty much the same assets that are allowed in money market funds, with a little bit, but by and large, they look like money market funds. Super highly liquid, very high grade, debt that these things can own. Tether is a different story altogether. And when people say, "Oh, all stable coins are the same," folks, let me clue you in: they are not all the same. If you look, as you said, it's gone from 17% to 24% of their assets are not really what we consider high grade debt. They have corporate debt in there. They have Bitcoin in there. They have like large,
gold,
these are volatile
metal
assets.
Yeah.
And so gold, it's insane. I don't know how people, if that's what you're looking for, if you're looking for a safe, stable place to put your, put cash, I can't figure out why it's Tether. But obviously there's some big driver because there's 160 billion or 180 billion dollars there.
Bo can explain it to us. Yeah,
Maybe.
It's easy to get kind of mentally sucked into the Tether kind of debate and controversies, right? And so I'm aware of it. it's like I got better things to do with my life. What I've always said, Jimmie, is that the reason Tether is stable or relatively stable, because it has broken the buck before, is because crypto markets and crypto traders need it to be. Therefore, they act as though it is. So it's almost like it is duct taped by collective psychology, and I think the consequences of Tether failing or breaking the buck are so dire that people just don't entertain that possibility who are actually trading and active in crypto markets, right? That's sort of that's kind of my perspective, not really based on empirical. It's hard to test empirically, but but markets are based on trust. At the end of the day, markets and all assets are based on trust and collective psychology here. So that's my take on it.
I was surprised to see that it had gone up to almost a quarter of the assets were in things that I would not consider terribly stable. And hey, this is a stable coin. If you're
allegedly,
I would be concerned. I don't have assets in Tether. I don't know if you do, but I wouldn't think so.
Absolutely not.
But I would be concerned.
Yeah. Okay. We'll leave it there. So another big announcement, Jimmie, last week from the Commodity Futures Trading Commission and their acting chair, Caroline Pham, who
Commissioner Pham.
she's kind of one of those people
Commissioner
who likes.
Pham is on a roll.
That's one way of putting it. Yeah, I mean, she's kind of one of these people who likes to travel around the world on the taxpayer dime and take selfies, and and I guess that plays well in the crypto universe. But she put out an announcement earlier this week that said that spot cryptocurrency products will begin trading for the first time in U.S. federally regulated markets on CFTC registered futures exchanges.
Hmm.
The announcement goes on to say that this marks a significant step forward in the Trump administration's pledge to usher in a golden age of innovation and make America the crypto capital of the world. So there you go. What a press release. This, like, I don't know what the hell's going on here, to be honest with you, and what legal authorities said, because the whole debate around market structure is that
Yeah.
the CFTC does not have regulatory oversight over spot commodity markets, right? This is why Congress has been spinning their wheels for, the better part of I don't know, a decade's too long, but the last couple of years,
Yeah.
trying to figure out how we regulate this. And she's just saying, hold my beer. Actually, we think we can just let CFTC registered platforms begin offering spot crypto products, is my read. So this really, I think, rather than answer questions, it raises more questions. The announcement doesn't specify what spot crypto products may trade on CFTC registered exchanges. It doesn't specify which CFTC registered exchanges such products may now trade. I don't know if this is actually helpful to the push to get market structure legislation, because it's, she's sort of saying, well, look, we're going to let it happen anyway. To me, it takes, some of the wind out of the sails of this bill. So I don't know what legal authority she thinks or the agency thinks they have to make this happen. But I guess it's a milestone. We'll see. I mean, my understanding is that Bitnomial is going to be the first, but I think Bitnomial has said that they're going to launch leverage products. Now, leverage commodity products do fall under the CFTC's
Right.
remit.
Right.
So this is what I'm kind of wondering: is this meaning that leverage crypto products can trade on CFTC registered platforms, in which case that is entirely consistent with the Commodity Exchange Act, or are they just going to allow spot crypto products to trade, in which case it does not appear to be consistent? We talked about this a few months ago.
We have talked. Well, I was going to say
So
we
I don't
talked about
know.
this
I mean, it's a
previously.
milestone, I guess. I just don't. It would just be helpful to kind of get an understanding of what legal authority they think that they have to allow this, and how the crypto market is going to respond. So I don't know. What are your thoughts?
I mean, so I think that obviously Commissioner Pham has been out in front of a lot of this stuff.
In front of a lot of
Definitely pushing.
cameras.
Well, definitely pushing the envelope on a lot of things, right? In particular, in her current role, and this seems to be this whole idea of acting versus a chair, or I mean, there's a lot of strange things that are going on in the world
Well,
right now.
she is embodying the Rodney Hood principle that acting does not mean inactive.
That's right. That's right. And it seems to be working for her at this point. But I think the idea of trading these as so I'm a huge fan of markets. You know this. I think that markets are this is where things we have theoretical pricing for everything, right? Everything has
Yeah,
a theoretical price. I mean, as an
yeah,
academic, that's what we do, right? We create these theoretical prices, but markets determine what price of something really is. Your theoretical of your price of your house may be 700,000, but the market will only give you 500. So you know what your
hmm
house is worth? 500. Regardless of what the theoretical price is, and the same thing goes for these assets. And so I mean, on the one hand, I 100% agree with, do they have the authority? I don't know. This is something new. But on the other hand, I do like the idea of spot markets being subject to markets, spot assets being, the prices being subject to markets, because
yeah,
you're going to find more truth there than you will in theoretical type pricing. And so, from a transparency
yeah.
and price accuracy standpoint, I love the idea. Whether they have the authority or not, that I guess that'll be debated.
Well, the key distinction, Jimmy, to your point, is like regulated markets bring greater price transparency, right? Because
Right.
there's markets for crypto. No one's denying that.
Yeah.
But they're fragmented, right? I mean, just go look online, go to go to any sort of token, price listing website, and you're going to see different prices across different exchanges.
Oh
You
yeah.
know, and sometimes quite a bit.
Hmm.
So yeah, I mean, I don't think anyone's denying that sort of bringing spot trading within a regulatory perimeter with, market integrity rules and trade reporting rules is not going to sort of make the market more transparent and efficient. It's just a matter of, is this something that's allowed? And we'll monitor this as companies
As
respond,
things go by, yeah,
if they
yeah,
do respond. Well, you mentioned you're a big fan of markets, Jimmie. I want to
yep.
end on a speech by someone else who's clearly a big fan of markets, because he made his way to America's first, or I guess most prestigious and longest running market, which is the New York Stock
New
Exchange.
York
Right.
Stock Exchange.
So, SEC Chairman Paul Atkins became only the fourth. I read somewhere only the fourth SEC chairman in history to deliver a speech at the New York Stock Exchange.
How could that
And
be? How could that be that he's only the fourth? Really?
I was surprised by that as well. I don't know why. I
Okay, that's an
don't.
aside. That's an aside. Forget
I
that.
just don't know. Like, I think I don't. Yeah, I don't think there's like a broader reason other than just like it's probably not like a forum like to give long speeches. Like I don't know. I mean, people
Maybe.
are busy there. I mean, they used to be
Yeah,
busy.
but
Uh,
they have the club upstairs and stuff. So
yeah. So anyway, this was a real stem liner of a speech. It was right up your alley. And he was really sort of placing markets and free markets within the context of, the ideals of the American Revolution and the
Mhm.
principles on which this country was founded, and sort of placing it in context of, the 250th
250th
anniversary,
anniversary. Yeah, coming up soon.
which is coming up. There was a couple sort of policy, I don't want to say announcements, but within the speech, he touched on a couple of his broader goals, which he's talked about previously. One is on disclosure. He thinks disclosure requirements have gone completely out of control. He wants to streamline that, simplify that, return it to just strictly investor materiality disclosure. He also wants to tier disclosure by issuer size. So essentially, if you're a smaller issuer, smaller company, you shouldn't have to be subject to, the same amount of disclosures as a big company.
So what do you think about that, Lee? I
So
haven't.
I don't like. Okay, I'm glad you asked me that.
Yeah.
Again, with all these things, it's like, well, give me more detail. Like, what do you actually have in mind? But I mean, materiality is materiality. Like, if I'm an investor, I don't see why it matters if it's a small company versus a big company. I mean, the information I presumably would want to make an informed decision would be the same regardless of the company's size. Am I wrong,
So,
Jimmy?
I differ with you a little bit here, the reason, and it's not because I don't believe in disclosure, but what I do see is the number of companies that are choosing to stay private rather than go public, and I mean, often it's not only the initial cost of going public, it's the ongoing cost, the reporting costs, and things like that of being public, and I think what's happening is the American public is being, kind of denied a lot of opportunities to invest in the next Apple or,
Yeah.
the next big thing because because reporting and things like that has gotten so onerous. I think, having to go out and hire a, big four consulting firm or audit firm
Sure.
to, and the costs that go along with that. I mean, I've seen some of the estimates just for shareholder meetings and preparing shareholder materials are like unbelievable for large companies. And
Yeah.
so, and it's not that I think that there shouldn't be transparency, but I think that, if we want to bring public markets back, and folks, the public markets have, I mean, you might think they've grown. They have decreased significantly over the last
Yeah.
15 years.
Yeah.
I
Yeah.
mean, we're talking like by over half, the number of public stocks available on like the New York Stock Exchange and places. And so, while I like the idea of the disclosure and things like that. I am also very cognizant of the fact that it's becoming companies are choosing not to go public because of the
Yeah.
cost in a lot of cases. So I think it's a two-edged sword.
Well, look, this is a conversation. I mean, this is like a multi-hour podcast conversation. If we want to talk about this, it's obviously an issue that Chair Atkins is very focused on. He
Yeah.
says he wants to make IPOs great again. He's clearly concerned about the decline, as you said, in the number of publicly traded companies. I agree that it is concerning and that there is a benefit, not just to individual investors, but just a policy benefit to having more publicly traded companies and the disclosure and price discovery that facilitates, right?
Yep.
So, the issue is what to do about it. He obviously is of the camp that, arguably the main culprit is the fact that being a public company is it's too costly and too big a pain in the ass with all these disclosure requirements. So let's simplify it.
Yeah.
Okay. There's other versions of the story, which is, well, actually the SEC over the years has made it easier to, stay private and, expand pools of private capital. So there's sort of less reason, because it used to be if you're a company and you were growing, right, ultimately the largest pool of capital to tap was public markets. That is no longer the case, right?
Yep.
But then there's just there's also, sort of exogenous factors like technological trends, economies of scale now, right? Just think of all the companies that Amazon has put out of business, right? So, there's a lot of reasons here. He's obviously focused on streamlining disclosure. He talks about, shareholder lawsuits, wanting to help that. So, again, this is sort of putting his sort of policy prescriptions into sort of the broader context of the revolution. I don't know. It's kind of, I didn't really think it was that compelling of a speech. I mean, this guy is a diehard libertarian. I mean, the tell is that he quotes von Mises, which is, not American, by the way.
Really?
Yeah, right. I don't know. Are you like, the one thing I liked about it is that he had a great quote from Mr. Buffett, Warren Buffett, in his Thanksgiving letter, which I remember when the letter came out a few weeks ago.
I think we talked about it, didn't we?
I don't know if we did or not, but we should put it in the show notes. Anyway, so in his letter, Buffett talks about, some of the disclosure requirements increasing. And so Atkins quotes Buffett, who says, "During my lifetime, reformers sought to embarrass CEOs by requiring the disclosure of the compensation of the boss compared to what was being paid to the average employee. Proxy statements promptly ballooned to 100 plus pages compared to 20 or less earlier, but the good intentions didn't work. Instead, they backfired. Based on the majority of my observations, the CEO of company A looked at his competitor at company B and subtly conveyed to his board that he should be worth more. Of course, he also boosted the pay of directors and was careful who he placed on the compensation committees. The new rules produced envy, not moderation," right? So sometimes disclosure is not necessarily the answer if it's not material. So take a look at the speech, folks. Are you watching the Ken Burns American Revolution series yet?
I've started watching that. I watch pretty much everything Ken Burns does.
Yeah, you got to. It's fantastic.
I mean, they're so good.
Long episodes.
I actually subscribed on, I don't know what channel it is, for the PBS stuff, just for Ken Burns.
Yeah. So I got it on the app, the PBS app, and I'm chipping away at it at the gym on the bike and on the elliptical. When they were, the Continental Army was camped out at trying to survive the winter at Valley Forge. I don't think they were sitting around the campfire talking about, how just, man, if we can just get through this, we'll have, free capital markets.
Yeah.
But, according to Paul Atkins, that was the whole point of the revolution. So, different interpretations, I suppose.
Maybe a little bit different.
All right, brother. Hey, a lot of fun. We left some stuff on the table. We always leave stuff on the table, but that means, we're going to have plenty to talk about next week.
A lot next week. It's we're coming in here to the end of the year. Always an exciting time in all kinds of markets. That we're at a place now where there's a lot of things going on. It's really constant. For our listeners, stay tuned. We love hearing from you. Even the bad stuff, we love hearing from you. So keep giving us the feedback, and don't forget the survey. Please get the survey done.
All right, Jimmie, take care.
All right. Have a good weekend.